Welcome to Nasdaq Trade Talks. I'm your host, Jill Malantrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Mike Sokol, who's the senior managing director on Nasdaq's market intelligence desk with our midday update. Mike, as always, thanks so much for joining us on Trade Talks. And it seems as if we're taking a little bit of a breather today compared to the action that we saw on Monday and Tuesday.
Yeah, I think we have a little bit of a standoff between the bulls and the bears. I mean, the market hasn't moved much at all today, down 60 points in the Dow, been steady throughout. Mostly you have your safety sectors that are outperforming, your utilities, your staples, your real estate, at the expense of your growthier areas. And pretty much the rally last week was driven in part by hopes that the Fed will be accommodating on rates, and that gave us a 6-day rally going into yesterday afternoon. So I think today's just a little bit of fatigue on that note.
And that's exactly what I wanted to ask you. We'll pull up our next chart here, FOMC stats, and we can take a look at, or rate scenarios, excuse me.
Yeah.
Is there some exhaustion here? I mean, there's so many different kinds of scenarios, and we can clearly tell by what the market is thinking here. And I'll tell you what, it seems as if equity traders, their fingers are crossed that we're going to get some kind of rate cut in the future.
Yeah, and I think that's what's really driving the market. If you look at the trade headlines, they're not really that great. You know, China and the U.S. seem to be hardening their stance. You just don't know if there's going to be a resolution anytime soon. The Mexico thing added a bunch of uncertainty to the market and really hurt stocks, but then it turned itself around. But really, I think this chart helps explain why you did have a rally last week and going into the beginning of this week. That green line is really what the story is. That's the chances of the Fed standing pat on rates and doing nothing. And if you go back to March, it was 90%, and that's plummeted. You can see it now. It's 30%, or it's gone down to single digits. What's taken over is potentially the Fed doing 2 or 3 rate cuts during the year. And a lot of that's been driven by economic data, both here and abroad, people worrying about the trade impacts as well on top of that. And then you had just recently in the last 2 days some PPI and CPI numbers in the U.S., all of which suggests lower growth. And that's bad for the economy, of course, but that also gives more room for the Fed to cut rates. And so it's a balancing act, and the market has responded positively, at least up until now, hoping that the Fed will be accommodative.
Do you think 2 to 3 rate cuts in 2019 is a bit aggressive? Because right now the economy is not that bad. What happens when, and it's economic cycles. It doesn't matter who's in office or what's happening within the markets. Economies go through cycles.
Yeah.
We're not going to have many tools in the tool chest if we're cutting rates 2-3 times in 2019 when the economy is still relatively good here. Yeah,
and that's the debate. Is the market getting ahead of itself? Will there be a reckoning if it gets ahead of itself in its hopes for what the Fed might do? And the Fed, being data dependent, might decide that it only needs 1 cut or none. But the market seems to be looking at things like bond yields going down significantly, negative rates in Europe, other market-based indicators, and the argument is, should you be forward-looking or should you be data-dependent, which is backward-looking? And that's always a tough call. But yeah, you can make an argument the economy's doing pretty well.
For as long as you and I have been in the business, can you recall a time where the Fed has been as married to stock price movement as it is right now?
It seems very evident that there was a U-turn since December, and that seems driven by the fact that the market sold off pretty sharply. You remember Christmas Eve was a pretty brutal day in and of itself, and it seems like since then the Fed, in its statements, in its everything it said, even Jerome Powell just a week or 2 ago talked about being accommodative to the market. So yes, they watch that, and they would argue that they're looking at market-based signals that are, ahead of the economy. But it does seem very much like the market believes that the Fed has its back.
All right, well, shorter term for 2019, we need to see this orange line scenario play out, that's for sure.
Yeah.
All right, Mike, thank you as always for joining us. And thank you for joining me on Trade Talks. I'm Jill Malantrino, global markets reporter at Nasdaq.